All right, welcome back, traders. John Caruso, Senior Market Strategist here, and this is another edition of Rolling Trades with RJO Futures. Today is July 9th. We've prepared a slide deck for everyone here today. We're going to take a look at some current events. We're going to look at the macro. That's one of my favorite places to start typically. And then, of course, we're going to take a look at some charts. But some current events right now that are affecting markets. Today is July 9th. If you recall back during the tariff announcements back in April 2nd, we did see the extension 90 days. Today is the deadline. So we are starting to see a lot of trade tariff letters that the president is sending out to several of our trading partners. No real details as of yet. I know there's going to be more to drop over the next 24 to 48 hours as well, but today was the deadline. We did hear from Donald Trump earlier in the week. They are going to, so the letters are going out over the next 24 hours, but they are going to extend the deadline once again to August 1st. So we continue to kick the can down the road. So any tariff announcements that come over the next 24 hours, those won't go in effect until August 1st, effectively giving countries another 3 weeks to negotiate trade negotiations. So the other current event here, we did just see recently the big, beautiful bill signed into law on July 4th that did, of course, pass through the House and Senate. Of course, that permanently extends the 2017 tax cuts. It expands spending on national defense, no tax on tips, overtime, or auto loans. And it also does boost the child tax credit. We also did see SALT deductions raised as well through 2028. The cuts that are coming to healthcare and food programs. Now, some of the negatives that we see in this, of course, that's going to add $4 trillion to the national debt. It's going to increase deficit spending on an average of 7% to GDP over the next decade. So clearly it's, a case of, meet the new boss, same as the old boss. Spending is going to continue. The national debt is only moving in one direction. So that is, of course, a big concern going forward. We're going to hit on that and how that's affecting markets later on in this segment. So let's jump into the macro real quick. Taking a look at Q3, we are coming out of a positive quarter. Q2, we did see a growth and inflation acceleration through Q2. That, of course, was reflected in a lot of the asset values that we've seen. Going into Q3, we are expecting a more stagflationary setup in the markets. We do have a deceleration in growth across the board. For Q3, we're looking, these are, of course, nowcasts and estimates. We're looking for 1.32%. Q3, that is compared to the base effect of Q3 2024 year over year of 2.72%. So year over year, we're seeing a slowdown. As we move into Q4, we have estimates of 1.35% GDP growth. If you look at the base effect from last year of 2.53, once again, another year over year deceleration. So growth is set to slow, we believe, in the back half of this year. That is the highest probability. We are starting to see some cracks in the labor market, although we are coming off of a positive reading in labor in the most recent non-farm payrolls report. But we are starting to see some cracks start to surface. We're starting to see unemployment claims rise, a decline in prime age employment, and of course, a slower pace of hiring. So that's where we're at on the labor front. As far as inflation is concerned, we are forecasting inflation to reaccelerate in the back half of the year. Some of the factors involved, of course, could be tariffs, the big, beautiful bills, deficit spending that fuels asset bubbles. All of that leads into higher inflation. We will get CPI and PPI readings out next week. But right now we are forecasting an accelerated pace of inflation. The June forecast right now we have at 2.64%. That is a slight uptick from the May reading of 2.4. Once again, we won't see that until next week. So taking a look at this chart here, of course, we've got CPI. You can see the big acceleration that we saw from 2020. We saw CPI reach north of 7%. I believe it was around 7.5%. And we have seen that cool off sequentially pretty much in a straight line. But we believe that that is set to reaccelerate. As I mentioned, the big, beautiful bill, deficit spending, very inflationary. The tariffs could be very inflationary as well. And of course, we've got a president who continues to badger the Fed chairman over interest rate cuts. So if we are starting to pick up some clues that President Trump might be interested in installing a shadow Fed, that would be where he announces his Jay Powell successor early. And this could, of course, be someone that falls in more in line with what Donald Trump wants to see in terms of interest rate cuts. I know there was something out there here today that suggested that he believes interest rates, Fed fund rates, should be 300 basis points lower from where they're currently at right now. So just think in terms of what that's going to do to fuel inflation going forward. So that's where we are. Taking a look at this chart of CPI, if you take a look as to where we're at, the last time inflation became unhinged, you can look all the way to the left side of that chart. It was 1969 going into 1970. We saw a massive move up to about 7.5% in CPI. We saw a big cool down to current levels where we're currently at right now, about 2.5 to 2.6. And then we saw a massive reacceleration into 1975, and that, of course, led Arthur Burns, the then Fed chairman, to cut interest rates while they still haven't fully solved the inflation problem. And at that point, the toothpaste was out of the tube, and that's how we got to where we got by 1980 with rampant inflation north of 15%. So. That is a look at the macro backdrop. Stagflation is the highest probability, we believe, going forward. So how do you want to position your portfolio? These are back-tested markets here in these type of backdrops where you get slowing growth, reaccelerating inflation. Gold and silver, those are the number one assets to hold. We're going to take a look at those charts later in the segment. Energy futures also tend to perform well. Crude oil, gasoline, heating oil, even natural gas, even though natural gas's trend and chart doesn't currently support positioning in that direction just yet, but we're going to be watching for clues there. And also agriculture futures, similar to natural gas. We don't have the bullish trend in ag futures just yet, but we do have some clues that agriculture is beginning to form a bottom going forward. And we're also going to be looking for ag clues of ag deals in some of these tariff announcements as well. So as you can see, top performing asset classes year to date. Take a look at the metals there. Gold up 25% year to date. Look at a year-over-year look. It's up 38%. Silver up 25%. Year-over-year up 18%. Copper 38%. We just had a huge move in copper in the last 24 hours off of some tariff announcements. That's up 18% year-over-year. Platinum up 52%. Palladium up 23%. So some massive moves we're seeing right now in the metals futures. As you can see, that's one of the number one places to be in a stagflationary backdrop. Taking a look, I also have crude oil. Crude oil is actually down year to date, down 4%. But over the last month, as we move into the stagflationary setup, it is starting to pick up some steam, up 7% on a month-over-month look back. So going to be interesting to see how that develops going forward. We did just recently hear from OPEC. They are looking at raising production again. That kind of wonder, you kind of wonder why, because all we hear is about a well-supplied market. Why are they interested in increasing production further from here? So going to be interesting to see how that plays out. That is likely to go into effect in August. Now we're going to take a look at some charts here. Debt devaluation and the policy playbook. I wanted to share this quote from Bridgewater and Associates founder Ray Dalio. When countries have too much debt, lowering interest rates and devaluing the currency that the debt is denominated in is the preferred path government policymakers are most likely to take. So it pays to bet on that happening. Now, what does that mean? We just talked about the big, beautiful bill, increasing deficit spending over the next decade, increasing the debt by $4 trillion over the next decade. We're going to take a quick look at the U.S. dollar. What has the dollar been doing since the beginning of the Trump administration? It is down more than 10%. Everybody take a look at that chart, because that is the purchasing power of your money being deflated and inflated away through higher asset valuation. So take a look at that chart. It's down 10% year to date. If you take a look, we have seen the last 4 or 5 sessions, the dollar is trying to pick its head up a little bit here. If it tries to make a run into the top end of my Bollinger Band, about 99, I don't think it's going to get much far beyond that. And then, of course, perhaps we could be walking into some interest rate cuts in the back half of the year, and that is also bearish for the U.S. dollar. So the dollar is being deflated, and as the dollar gets deflated, what gets inflated? That is gold prices. If you take a look at that longer-term chart, gold is certainly in charge. We just took a look at the year-to-date performance, up 25% year-to-date. Now, we are in a little bit of a sideways consolidation period for gold right now, but it is building out what we believe is a bullish flag on a monthly chart. We could kind of meander sideways a little bit for the next couple of weeks, but we do believe going into the August expiration and coming out of that and heading into the fall and potentially some interest rate cuts, we are going to see significantly higher gold prices. The fiscal issues here in the United States that we've been highlighting, those aren't going anywhere. We know the policy path forward is likely dollar devaluation, so you want to be bullish on assets that have an inverse correlation to the U.S. dollar. I think it's really as simple as that at this point. We're going to take a look at silver. Silver is one that we've been pretty active in here, recommending to traders. So long as we're carrying a bullish trend, we are trading that market from a bullish viewpoint. As you can see, similar to gold, there's a little bit of a scaled back look at silver. It is sideways consolidation. That is still a very good pattern on the chart. We do have targets. If we can clear 37.40 over the near term in silver, we see a clear shot to 38.80 and possibly testing the top of that trend line, that upward sloping trend line, which comes in up around 40. So silver, much like gold, it shares some precious metals qualities. It also shares industrial metals qualities, and I'm going to show you the main industrial applications for silver right now, and that is solar additions. Take a look at China's unstoppable solar additions. Take a look at May. That's the most recent reading we have for China. You can see an absolute explosion in China's increase in solar additions. Silver, of course, is a main that's a main component of solar paneling and other solar applicants. So very interesting to see that and how that could correlate with silver prices going forward. Now, last and finally, we're going to take a look at July copper. Look at the diamond formation that we were highlighting and calling for the breakout. That was my last podcast. I think it was back, it might have been towards the end of May or early June, but we were looking for that diamond pattern to break out to the upside, and it was very sloppy for a little bit there. And then, of course, yesterday we had the announcements of the tariff, the 50% tariffs on copper imports by Donald Trump, and that just sent off an explosion. Now, when you take a look at that chart, how do you trade it? You can't chase it, in my opinion, if you're not already long that chart. What you want to do is if you want to start trading it actively, pull up an 8-day moving average. Okay, if you pull up an 8-day moving average, pullbacks into the 8-day moving average should hold if this breakout is real. So pull up an 8-day moving average on your chart, follow that, and use that as a key support level going forward if you are not already involved and want to look at getting involved in that market. So look for pullbacks into the 8-day, look for the 8-day to hold and trade bullishly so long as we're carrying the bullish trend. So that's, I believe, a wrap for you guys here today. Once again, I'm John Caruso, Senior Market Strategist. I write a market insight note every single morning. If you want to jump on that mailing list, it is free of charge. All these insights and more come directly to your email box every single morning. And just feel free to ping me at jcaruso@rjofutures.com or give me a ring at 312-373-5286. Best of luck to everybody out there. We'll catch you back here next time.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.